Everybody here knows Walt, and I'd just like to say thanks to Jesse to joining us for an hour conversation and educating us on all the things. I'm going to let you
Yeah, this is
guys.
one of the things that I enjoy doing the most. So meeting with
Awesome.
the professional side of things is exciting.
Good. Okay. Well, I'm going to be working on doing the CEs for all of everyone who's in here. And yeah, so take it away, Walt. Thank you.
Perfect. Hey, thanks, Tracy. So first, thank you so much, Tracy, for hosting this and for Fidelity hosting this. We couldn't do it without you, so we do appreciate that. And of course, if you're not using Fidelity, please use Fidelity. You're, in my opinion, the best title company in town. I get the best service, the easiest closings, and that through Fidelity. So I can't endorse Fidelity enough. So thank you.
Thank you for that.
Yep. And then today we've got Jesse with us. Jesse, I've known Jesse now for, man, 4 years, 5 years. I don't even know what it is.
Just coming up on 5. Yep.
Yeah, that's what I was thinking. So Jesse and I got connected through another friend of ours. But for years, I've been in the business now, 27 years, that's a long time. And so I think I'm going to stop saying things like that. But I've been in the business a long time, and I've never really had a good, solid credit repair company that I trusted, honestly. So I never referred one for years up until I found mycreditguy.com. And so they are by far, again, like Fidelity, the best company that I've ever worked with, I've ever seen. Most importantly, the things that I've found with mycreditguy.com with Jesse and his team is that they're honest. And finding a good credit repair company that is honest, that's why I never referred one up until I found mycreditguy.com. So Jesse, can you tell us a little bit about yourself and what you do for mycreditguy.com and
Yeah.
how you got in the industry?
Yeah, for sure. Well, thanks for having me. So, the My Credit Guy story
Go ahead.
also kind of encompasses not just our business, the people that work here, how I joined, how I got involved. It kind of says everything. So I'll start there, right? So, My Credit Guy just hit its 10-year anniversary. And it was started by husband and wife, Sam and Trisha Parker. Walt knows Sam very well, Trisha too, I'm sure. And so we've just known each other for quite some time. When good people meet in the industry, for those of you that are on here that are in it, we stick together, and there's a lot of good things that come from it. And when Sam and Trisha started this business, they set out to do things different, right? So credit repair. If you've been in this industry for any time, you probably turn your nose up at that comment, right? Like there's a negative connotation associated with credit repair, just the same as which is also not fair a lot of times, the used car salesman, right? So and we again, when Sam and Trisha started this business, they set out to do things differently because they'd been in it before. And so when they started their business, they wanted to be very specific. And one of the ways that they decided they were going to be different is that they were going to partner with the professional, right? Like, so the relationship was with the loan officer or a real estate agent, and the goal was to help them build their business, right? Like, how can we be an extension of that business, right? Like that arm of how do we, nurture relationships and help people improve credit, so we have performers like Walt or a real estate agent where they can stay focused on originating loans or closing deals and selling houses. And so one of the things that we decided a long time ago, and it's very true today, even after 10 years, is that we don't do consumer marketing, right? Anything direct to consumer. Yes, there's a lot of information that we post about credit education that is tailored towards the consumer, because the relationship that we have with the loan officer and real estate agent, that's the information they need, right? Like, ultimately, this is information that's going to make it to your clients and create a great opportunity for them to better their future with credit enhancement and improvement, right? So like, this information is not just for people that have bad credit, right? Like, in the mortgage space specifically, having a great credit score right, is a major difference in how things will finance. And one of the things that I think you should definitely take note of is on the recent posts related to this event. Walt broke down a very specific kind of overview of what a different credit score needs for a transaction. And when you look at that, for any consumer that looks at that, for any professional that looks at that, obviously those are big numbers, right? And so my credit guy is built specifically to focus on that mortgage process. So that means our coaches, our onboarding specialists, we all understand the mortgage process, different types of loans, the credit scores that are specific to mortgage, and we'll dive into some of that a little bit later. But how I got involved in the industry is that Sam Parker happened to be the very first friend that I met at college. He and I were youngsters. We've known each other now for over 20 years. And we got into sales, and then he ended up in credit repair, right? Like we found out what sales was and relationships and commission, and we said, forget this school stuff. I did anyways, right? I was like, I'm just gonna go to work now. I've got this figured out. But we sit here today, him with over 20 years in the industry, me with now 5, because I've known him for so long. He always said, like, Jesse, the business is going really well. I'd love to fold you into this, right? Just being great friends and knowing that we work well together or have in the past. It all just lined up 5 years ago. So since then, my job has just been building relationships. So we have my responsibility is to take care, even if you're a one-person shop, you have access to my cell phone. If you've got a credit report to look over, if you have a client that needs help, you have access to my cell phone just the same as the company or shop that has 40 people. And Walt happens to be a part of Cross Country Mortgage, and they are we're preferred. We're the only approved credit repair company for any of their loan officers. So all the way to the top of companies that have 2,000 loan officers, right? That we build processes and procedures for. You as an individual can get that same access. So we're going to be talking about some of those details today. But really, well, I don't want to talk out of turn here, but really our focus is like driving home like some good, solid credit education content. That there's a lot of things that are misunderstood about credit, and there's a lot of hot topics for the time that we're in this industry with a bunch of changes.
Yeah, well, let's do this. So first, let's talk about medical collections. There's been a lot of miscommunication when it comes to medical collections. We heard not too long ago. And let me back up. First of all, not only do we have realtors on the call, but we also have a lot of my clients on the call too. So we've got both realtors and clients on the call right now. So if we can talk kind of in a broad view. So again, medical collections, we heard we're going to be taken off of the credit report. This was going to happen. What was it? The end of last year, I think it was, start of this year. And then that's been kind of postponed, right? And we'd heard that with medical collections coming off the credit report, that would increase scores. And that would also give the ability for a lot of those people that have medical collections now to be able to have those wiped out off the credit report to be able to buy homes. Can you shed a little light on that for us?
So medical collections has been in the news related to credit for quite some time. And actually one of the first changes that happened, right, was at the very beginning of this, and we're talking 2.5 years ago, they said essentially any medical related debt could report to credit at 6 months. They extended that to 12, right? So you essentially, if you had a debt that was out there, that company that was pursuing you for that debt needed to work to get in touch with you to resolve the issue in some way, shape, or form for payment before they considered it defaulted and send it to credit, right? So that extended to a year. So it gave a little bit more of a grace period as people transitioned out of what could be a big event in their life. The next thing that took place is they said any medical collection that is paid off, or excuse me, any medical collection that is paid to $0, whether that's through a settlement or for a full payment, if the balance hits 0, it has to be removed from your credit report. So the next thing was, if you truly resolve the collection, it then would remove it from credit, right? And then the third thing, right, that eventually came was that if it was less than $500, this was like 6 months later, it was the next step in progression. If it was less than $500, then we would then it also would get removed. So that was about a year ago now, right? So I believe it was in May of 2024. Any medical collection that was a balance of less than $500 that automatically got deleted. That was a huge shift, right? So in about a year ago, we saw, I think it was 73% of all medical collections that were reporting to credit just completely got removed. Now, it's really important in discussing that in collections and what reports to credit. That doesn't mean that that debt's wiped out. You're still responsible for that debt, right? And so the collection company could still pursue you for that, which means that unfortunately there's times where they could file a civil judgment, potentially garnish wages, tax returns, stuff like that, but it would not affect your credit. And then, eventually with those, your credit score goes up and it increases likelihood for you to buy a home. The most recent progression was that it was announced at the beginning of the year. This was kind of the last piece that wasn't discussed a lot because people didn't think that it necessarily was going to completely go through. But it was the final ruling and decision to move. This was, I think, announced in January that this was moving forward, maybe February, that all medical collections, doesn't matter what the amount is, if it was a $10,000 debt, that would be removed from credit. So that announcement was made. It was put into place to happen, and then it was supposed to be effective right around now, right? So beginning of April is going to go into effect. 60 days from when they announced it had to hit Federal Registry. And then with the changeover in administration this year, they've actually pulled back on that, right? So it's not that it won't still happen. We just don't have a time for when it will or if it will, right? So where we stand today is still anything less than $500 will not report and has been removed.
Perfect, perfect. So talk to us a little bit about, and to let you guys know, the last 10 minutes, we're just going to have questions and answers. So any questions that you guys have, feel free to ask away. So I've got a bunch of questions here, but it'll be open to everybody else. Talk to us a little bit about FICO score, how many FICO scoring models there are and why that's important, and Credit Karma. So I get asked yesterday, literally it's almost daily. Well, I know my credit score. And my second response is, great, where did you find your credit score at? Well, it's either on my Discover statement or it's Credit Karma. And so talk to us a little bit about why does Credit Karma, why are their credit scores so different than the ones that I'm pulling?
Okay, so there's a few things here that I think are super important to unpack. We're going to go credit scoring models. How many different ones does FICO have? Why is Credit Karma different? What about my Discover app? It's a bank, right? Why isn't it showing the same credit score that you have, right? Like there's a lot here. So the first thing I will say is asking me how many FICO scores there are is about as fair as asking somebody what their credit score is, because really, if somebody asks you what your credit score is, the first thing you should say is, well, which one, right? And that's where people get very confused, is that they think they just have a credit score. I just have a grade. Or I might have some people will say, like, I know I have 3 different credit scores because there's 3 different credit bureaus. So they're a little bit more in the know, because that's the truth when you pull a mortgage report, right? You have 3 separate scores. So let's break this down. Just to be perfectly clear, I don't even really know exactly how many FICO scores there are today, because they continue to grow. I know that there's 2 through 5, or excuse me, 2 through 10, but there's variations of those, right? So there's the FICO 10, there's the FICO 10 auto, there's the FICO 10 credit card, right? Like there's different scoring models that are built for different scenarios, okay? And so I would say that there's easily above 50 different credit scoring models, which would produce the potential of a different credit score that FICO is built. And what we have to remember is that FICO is a company that's their business, is they're building risk models through credit or through referencing credit information to produce a score, right? And it's a tool and a product that's been sold to companies to help them assess risk of their potential borrowers. And when Walt and I were talking the other day, one of the things that may seem kind of out of the ordinary is that you could have different credit scoring models that are picked and used because their effect is different in different regions, right? Like different regions of the country, people behave different ways as it relates to borrowing money and paying it back. And it's just, there's just trends of human behavior. So with FICO, the newest one that's out is the FICO 10, right? So it just progressively gets to a higher number. And actually more specifically, the newest one is what they call their 10T. It means trended data, right? So what you're going to normally see for, and I'm going to transition to lender scores and consumer scores, right? Like I categorize those in two different categories. You can get access to lender scores, but you have to, use like myfico.com specifically. In this situation, when we talk about like a mortgage score, that's a lender score, it's the FICO algorithm number 2, number 4, and number 5. And those specific models are overlaid to, one specific credit bureau of information. And that's why when you get your mortgage scores, you have 3, and then we go off your middle score, your mid score. Now, FICO has consumer scores as well, right? Like scores that are built that they use, like FICO 8 is a very common consumer score, and FICO 10 sometimes even shows up as consumer score. Now, what I mean by consumer is like truly just the people and their scoring model. And people ask the question, well, why is there a consumer score? Don't we have credit scores just for like figuring out how we can get money lent to us? And it's like, yes, that is absolutely true. But these companies are trying to make these different types of credit scores exclusive because that keeps the value of them up, right? You don't want your lenders to have easy access to a low cost credit scoring model that a consumer has when they're making money at like the professional level. And we don't necessarily need to dive into that, but that's how it works. So if you're looking at an application, right, that's free or low cost to you, most likely that score is not going to match most of anything that you would see when you go to purchase something and you're wanting to finance it. Okay. And what I mean by that is like the FICO 8 score, people might say like my FICO score is this, and we're getting closer, right? But we're still not there because FICO 8 is not the same as 10, is not the same as 5, and it's not going to show up on a mortgage score at all. Now, to make things even more complicated, we have a new player in the game, right? So FICO is the entity that provided these services. Excuse me. Now we also have Vantage Scoring Solutions, which was started in 2006. Vantage Scoring Solutions is actually a joint venture between Experian, TransUnion, and Equifax, as silly as that sounds. And FICO now has competition. And the scoring model is not only it's different for sure, right? Like the way that it's broken down is different, and how they value different categories of behavior and your decisions financially. In those scenarios, you're going to see the name of that credit score called a Vantage 3.0, right? So most of the applications that you have, even if it's your bank's access to a credit score, is going to be built off the Vantage 3.0 scoring model. And the one that's most well known, we've talked about it today, Credit Karma. If you look at the details, right, of the scoring model, you'll see Vantage 3.0 right there. And what that means is that a lot of times is far off from what's being assessed by a lender specifically for a mortgage. Sometimes, I mean, Walt, I'm not sure what you've seen, but I've seen it vary anywhere from 80 to 100 points at times, right? Like a credit score that shows way higher on Credit Karma than for a mortgage score. And guys, when it comes down to it, the reason that is because the different scoring models are based on like how stringent they are, right? How specific they are, and how aggressive they are in grading your ability to pay something back or your propensity to pay something back, right? And you have to imagine that the strongest grading scale obviously is going to be for the largest investment, which is a home, right? And so you'll see that sometimes you have a lot better credit score when you go to purchase a car than if you were 2 months later to purchase a home. But that's because that's a much smaller for most people, right? Like some people buy cars that car is worth as much as my house, sure, but on average, you're going to be dealing with a lot less, lot smaller amount of investment.
Yeah, and that's what I tell my clients, and that is, um, our when we pull a credit report, our FICO scoring model is going to be the most stringent. I mean, we're lending, $400,000 or $500,000 or so. If you're buying a $400,000 or $500,000 car, do you need credit? Anyway,
And though that's interesting, I actually get into a good amount of those conversations where people are saying, Jesse, I could pay cash with this. And I'm like, well, it's, nice to be you, right? Like, that's good for you, right? But they say, like, I would much rather finance it at, the 2.3% interest that they're going to allow me, because I could take that money and put it somewhere else, right? So even those folks that could pay cash, they still value their credit score because they know how much it works for them.
exactly. And certainly, when you go to buy a car, that FICO scoring model, when they go to pull typically just a beacon score, is going to
Yeah.
be much less stringent than what an auto or a home would be. And you go to a credit card, again, a credit card is going to be much less stringent. So we see, we'll have clients that will say, well, again, Discover, because I think of Discover right now because I get my credit score every month from Discover. And I watch my credit score between Discover and between Credit Karma. And it's funny, the difference even between those, and they can easily sway 30, 40 points just between those. I think right now the difference is actually, right now it's about 100 points between the different sway. So I'd be curious to know if I pulled a mortgage. I'm not in not in the process of buying a house right now, but anyway. So as we look at that, let's talk a little bit about what are the things that really that can help you increase your score the most. I call it the credit score game, because I think that really having the highest credit score starts to become a game to a percentage. It's almost like our tax code. It's who can get the least amount of taxes, who can pay the least amount of taxes. I think that credit is a lot like that, in the sense of what are the things that I can do to increase my score the most and the quickest.
Yeah, I would agree with you. I mean, you could absolutely gamify the situation with credit, and it totally makes sense, because when it all comes down to it, it's all based on your knowledge and understanding of what it is that can move the needle on which way it can go, and then your behavior, right? So it's strategic, right? So absolutely, it's there's opportunity there. The answer to the question of, like, what's the thing that can impact your credit the most, it's kind of a tricky one, because it really just depends on where do you sit today, right? So, like, that answer is kind of unique to everybody, but I would say, based on as many as I see, what is commonly overlooked is excuse me, two things, which are the top two in the credit scoring algorithm: payment history, right? So, like, every single month that you're paying on time, that is like a coin in the savings bank of, I have good credit, right? It doesn't matter if it's $100,000 loan for a car or if it's a $20,000 loan for a house. Doesn't matter, right? Every month that you have an agreement and you make the payment on time, those standard consecutive payments equal the same thing. Those are all positive gains. Now, unfortunately, when you pay a loan off, you lose the majority of that credit towards your positive credit score. Okay. And so it seems backwards, right? Like, I made a commitment with a bank for 5 years on a car. I paid on time every month. Do you think that should strengthen my credit score? I do, right? They don't, right? And they're the ones that created the game, FICO or Vantage, whoever it may be, for those decisions. And as soon as you close that, it goes away. So this kind of rolls up into what I think is the number one impact of good credit, and how you then can fix credit, improve your credit. And that would be maintaining active credit cards every single month. The FICO scoring algorithm, from all the research that we've done, really likes to see at least 2, if not 3 credit cards at minimum that are open, active, paid on time every single month. Okay. Now, there's some additional, we'll call them accelerators on how much that's going to benefit you. Never have a late payment, right? Like one late payment can cost you 60 to 80 points right now. I don't care if it's just a $200 credit card. That's another factor here, right? It doesn't matter if you have $100,000 in credit card availability, right? Like credit availability, or if you have 1,000, it's all based on percentages. Okay. So, and those percentages are, and this is a great thing to remember, good, better, best for credit utilization. Good is anytime that you're maintaining at or below 50% of the limit that you have across one card and all cards together, right? So they're going to assess your utilization percentage for each trade line that you have, each credit card that you have, and where that percentage is, and then the total of all of your balances versus your limits, right? So in the situation where you have $1,000 credit card, having that balance rolling on a consistent basis below $500 is good. Okay. If you go over that, it suppresses your credit score. Better is less than 30%. So a lot of people will say that's the sweet spot. There's a kicker there. There's an accelerator. That's really going to be something that helps your credit is to keep all cards under 30%. But even better than that is the best category. And FICO loves when you carry a balance less than 10% of your limit. So a lot of people go, wait, what are you talking about? They said I could spend $1,000. I've only spent $600 or $700, and I pay it down and then I use it. I get it. You're a good customer to that credit card company. You are responsible because you're staying, you're obviously within your means to be able to pay it down and pay it off. Great. You are making payments on time. Fantastic. And you aren't anywhere near, maxing your credit card out. Good. But there's still a risk assessment that's being made on you if you're using over 50% of any card or the accumulation of all of them.
So let me make sure that I get this straight. Let's say that you have three cards all at $1,000 high credit limit. So you have $3,000 worth of total high credit limit. So what you're saying is that for just one card, I don't want to charge above 500 to have good credit. But overall, I don't want to be, what if I max out one card at $1,000 and I do another one up to 500 and I have nothing on that third card and I'm at 50% on that middle card? What's that going to do to
Let's
my
just
credit?
assume that in each one of those situations, we have three limits that are $1,000. So our total credit limit is $3,000. Our total spend or balance is $1,500. On your overall credit utilization, you're in the good category. Because you're less than,
Right.
at 50%. Right.
Yep.
On that one credit card, though, that's going to hit you. That's going to hit your credit score. So that's why it is you got to play the game and do both, right? And so
Yep.
what people ask me a lot of times is, Jesse, considering those details, where is it best for me to put my money? And there's a lot of things that I like about Dave Ramsey and his approach to paying off debt. I mean, like in that category, I line up with him a lot, not as it relates to a mortgage, as it relates to credit, like, of course. But what I will say is that he uses the snowball effect, and a lot of times he's saying, go pay off your smallest credit card first. And that's a good strategy. But if your focus is to increase your credit score as much as you can progressively as you're using that money to pay down cards, you're actually going to want to look at those percentages. And let's say you had $500 to spend, you're going to want to put that $500 and break it up strategically to draw each one of your balances down below those thresholds, and then ultimately your total below those thresholds as well. So if you can get two cards below 30% and then your total utilization below 50%, that's a lot better to spread that $500 over three cards instead of just paying one off and having that 0%. That's for sure.
Right. So now, one thing, I'll get self-employed borrowers that will come in and we'll start to strategize on, when do you want to buy a house? Do you want to buy a house this year, next year, the year after? Because of course, self-employed borrowers have a tendency to deduct everything they possibly can on their taxes, again, to lower the amount of taxes they're going to pay on a yearly basis. But I think there's some strategy that comes into play working with a self-employed borrower when you start to disclose more of your income and whatnot, depending upon the type of loan that you want to do, right? I think that also comes into play, and that's why I call this the credit game, because what I've been told, and correct me if I'm wrong, is that it depends upon, if you have a credit card, and let's just say that you have this credit card for business use, and you have a tendency to max it out every month. Well, when you get your bill and then you pay it off, at that point, if you're at 100% utilization, your credit's going to get dinged pretty good, right? And you haven't spread it out among other credit cards. You just have the one credit card because it's
Right.
business use.
Sure.
I think there's strategy that comes into play where instead of maxing out your card, or maybe you still max your card out, so you have a record of what you've spent in your business and whatever. But from there, what I've counseled clients to do is to find out when that account closes that month. So when does it close? And then when is that statement prepared and then sent to you? Because those two dates are different. And then your due date is something completely different. So when that account closes that month, then, and doesn't close permanently, it just closes. So then that way they can print the bill
The
and send it
cycle.
to you.
Yep.
The cycle close, yeah.
Yep.
So when it closes that month, a couple of days before it closes, you call or you go online, whatever, but you make a payment to where you're down below 50%. That becomes your new payment date, opposed to the payment date when you actually get your bill. Is that a wise path to go and kind of a good strategy to employ?
Yeah,
to be able
and
to
clap,
payment?
because the way that you explain that is perfect, and it's so important, right? Like this, and this is exactly an example of like this, and this might be the most appropriate example for like we're playing the game here, right?
Yep.
Because you get a statement date, you get a bill, you get a, when you're due, and it's like that's fine. And remember, like those are the things, those are the rules that they put in place, but you should be putting your own rules in place to make sure that you're benefiting as much as you can with the knowledge that you're gaining. Hope, like take all this in today, because I mean, well, when you're talking about self-employed borrowers, that comes up all the time on this end where they're going, Jesse, I max that credit card out 4 times a year, right? Or excuse me, 4 times a month. I'm paying that thing off 5 times, right? And I'd say that's fine. Continue to do that. That's totally fine. I know that everything has to run through that. I mean, it's just it is what it is, right? I have people that have $50,000 trade lines and they're saying like that thing gets up to over $45,000 3 times a month because they're a construction company, right? Okay, so here's what you do. Continue to make your payments as you need to allow for you to have the money available to continue to operate your business for sure. But exactly what Walt says, no longer is the date that you make a for sure payment to pay that thing down below 5% going to be based on when they make the rule of the due date, right? And I even go as far for these self-employed borrowers to say, I would call each of your creditors and just verify when the statement closes, is that when it gets sent to the credit bureaus, right? Most of the time it is, but I like to confirm that. And the reason that I like to confirm that is that for most credit card companies, you can change your due date, right? And that means that they're going to change the cycle, which means they're going to probably not change when they're sending information because they're sending that in batches to the credit bureaus, right? They're just kicking it out on one date per credit card company per account on a monthly basis. So say that they're pushing that information to TransUnion, Equifax, and Experian every month on the 19th. I tell my self-employed borrowers and even just general clients and consumers that are sticklers about their credit score, which is good, to make sure that they're making those payments by the 17th, right? I say give them a full 24 hours to adjust that in their system and ensure that the information that's getting sent to the credit bureaus is in your favor, right? So that you change the game there, you're good to go. So you just what I do with my credit cards, because and that's even more important as you're getting close to knowing you're going to make a large purchase, right? Like credit is most important, right? It is good to maintain it all the time because to get it to be really great in a short amount of time, sometimes that can get tricky. And so maintaining good and great credit all the time is important. But when you start to zero in on where can I get those extra 20, 30, 40 points to like skyrocket so that I'm in the top echelon, but that that usually happens or should happen for sure. It can happen all the time, that's fine. But for those of you that don't want to manage it super, super tight every single month, you just have to kind of see into the future of when you're going to make a large purchase. So for me, what I do is I have here's the other thing strategically, right? I'm not going to say I'm not responsible, but I'm not the best at remembering exactly when things are supposed to happen, right? Like I pay my bills every month on time, but the only reason that I can make sure that I ensure that I do that is I've got every single credit card that I have set up on auto pay, right? I've set it up for auto pay at the minimum balance. I'm never going to miss a minimum payment. And the reason I do that is because even if I'm not using that credit card and I paid that thing off 6 months ago, perhaps, sometimes an annual fee will hit. I have no idea. And then that, $69 fee that gets assessed, they're going to ask for 35 of that the next month as a minimum. And if I'm not paying attention to a credit card that I'm not using, it can go 30 days late, it could go 60 days late. And guess what? They're not calling you to let you know. So you've got 2 late payments. They're going to report to credit. You've got 2 late payment charges that are on your credit card. Now that $69 charge all of a sudden is turned into $150 in cost, which is nothing compared to the 2 late payments that you have on your credit report and how much that is lowered credit. So for me, minimum payment automatically withdrawn from my checking account. I'm totally cool with that. And to be honest with you guys, when I get that notification on my phone that says, thank you for your payment to Capital One for $45, that's my reminder to go in and click that notification, log into my Capital One account, and put whatever additional amount that I want to pay for that month, right? Like it's very rare that we should just be paying the minimum balance. So I'm usually making 2 payments in the same day. One that automatically goes out to ensure that I never miss one, right, for the minimum. And then the second one is my assessment of I need to throw another $300 or $400 because my plan is to pay that off in 6 months, whatever the case may be, right? Maybe there's a promo for 12 months, no interest. Cool. Well, I'm not paying the minimum. I'm paying that thing to make sure I get it paid off in 10 months, not 12, right? So I don't get hit with interest, whatever the case may be. So again, that payment reminder and confirmation is usually for me the indication that I need to log into the app and put some extra money on it. That's just my strategy and it's worked really well so far.
Yeah. And I think that, one thing that I've been saying now for years is that mortgages have changed. And the way in which we pay our mortgages, the way in which we create a mortgage has all changed. And it's really become strategy. Strategy is the most important thing in a mortgage anymore. Rate almost becomes irrelevant anymore, but it's strategy. And just like this, whether you are self-employed or not, if you want a higher credit score, hence that's one of the main factors that dictates what your interest rate is, then you've got to play that credit score game. You've got to go in and you've got to, before that statement closes out, you've got to pay down to at least 10% of your high credit limit, and to be able to get the best possible score. So all strategy comes into play here. And I will say that there's a massive difference between what the difference is between a 780 score, which Fannie Mae and Freddie Mac changed the loan level pricing adjustments to where it used to be 740 and above, you had the best possible score or the best possible rate. Now it's 780 and above. So in order to hit that 780, you've got to play that game. You've got to be strategic because anything can throw you off and get you into a lower credit score, lower than 780. It's pretty easy. And so they've made it more stringent. So let's talk and also to your comment, I love the fact that you have a minimum payment made on each one of your credit cards, just automatically. Let me just share a quick experience with you. I had a client that he was buying a house over on the coast. It was a second home. and it was their dream second home, husband and wife, and they're buying this house. And just the way that everything happened, he got pre-approved. He waited a few months. He then looked for a house, and then the seller drugged the process out a little bit to where we couldn't close in a quick fashion. But it took it took 2-3 months to be able to get any repairs done and everything else, which then meant we had to pull a new credit report. We pulled a new credit report, and in that time frame, one of his accounts, and it was a credit card, hit him for a 30-day late. And he didn't realize it. He's like, what? I wasn't late. What, you know, he didn't even think about it. And it happened to be Netflix that charged his credit card, which he completely spaced. And boom, he ends up having a 30-day late. And it happened to charge a credit card that he had on file that was no, I'm sorry, it wasn't Netflix. It was Amazon. So they charged his card that normally got charged for his monthly fee, ended up expiring. He didn't realize that. And then it charged his secondary card, which he never uses. And so he got the statement, but he didn't even look at it because he's like, I don't have anything owing on that. And because of that, the card went 30 days late, which literally kicked him. I took him from a great credit score below, he ended up hitting below 600. And at that point, knocked them out of not being able to buy the house. So, so it can really hit pretty hard. So let's talk about bankruptcies. As inflation's rising, bankruptcies are on the rise. We work with one of the #1 bankruptcy attorneys here in Salem and also in the state. And as I've talked to them, they're getting more and more calls these days on bankruptcies.
Yeah.
So what is the best way? Let's say that you declare bankruptcy. Between bankruptcy, you have a Chapter 7 and a Chapter 13. Chapter 13, you're still making payments to the court, which still, you know, there's some credit being had there. But ultimately on a Chapter 7, you wipe everything out. So now you've got to rebuild credit. So how do you start to rebuild that credit? What's the wisest thing to do? And how can you do it the quickest?
Well, you know, if you're in a Chapter 13, it's just going to take some time until all that's settled, right? Because those accounts are going to be in limbo until that's done and discharged. Chapter 7, right? Like some of those can take, you know, just like 60 days and then everything's wiped and discharged. And I mean, I've heard of people that after their Chapter 7 discharges, they're getting credit card offers in the mail within 60 days, right? So your ability to rebuild credit can happen pretty fast, okay? And now what I would say though is that if you go through a bankruptcy, you'll want a professional like Walt or myself or the combination of us, the two of us, to look at that report. And the reason I say that is because most of the time that we're dealing with credit improvement, repair, and the service that we do with a bankruptcy, it's because let's say there's 10 accounts that went derogatory, went late, and then it ended up in a bankruptcy. Those are all coded a different way based on credit reporting. It's called the MOP rating system, which stands for manner of payment. All right. So it goes from 1 all the way up to 9, and 9's not good. The higher, you know, the lower the better. So you might have a credit card that goes to a charge-off status, which is rated as a 9, but it was included in the bankruptcy. When that happens, all 10 of those accounts that were included in the bankruptcy need to be coded that way on their account reporting detail, which is now it's changes from a 9 to a 7. So they still negatively impact you. It's still not a good thing for your credit, but a 9's a lot worse, right? And so if you have a bankruptcy and then you have 7, 8, 9, 10 accounts that are coded as a bankruptcy, it kind of just is a part of the deal. If you have a bankruptcy and then you have 2 or 3 accounts outside of that that are reporting as, you know, previously 120 days late, whether it's a collection, whether it's charge off, that's kind of like hitting you twice for that negative life experience and event of the bankruptcy. So for us, when we look at that, it's just to ensure that the data is accurate. And I'll tell you, I mean, I could probably guide somebody through that, but to look through that yourself and to be able to see that level of detail, it's just tricky. Credit reports are not the easiest to read. And so when you're in that situation, if you've either had a bankruptcy in the past, or there's one that's fresh, I would say around day 60 after it's discharged, pull your credit, take a look at it, and get it in front of a professional. And then from there, once we can ensure that everything's accurate and how it's supposed to be, you just start building credit from there the same as you would any other way. A lot of people will snag somebody to drop them in as an authorized user on one of their credit cards that's in good standing. You can open secured credit cards, which is essentially like what you put a deposit down, and that's what serves as the balance that you're pulling from. It's like a gift card essentially, but it reports to credit. And you start doing some of those things, and over the course of 3 to 6 months, you'll see some improvement. 6 to 12 months will be even better. And I mean, Walt, there's been times I'm sure that you've seen somebody discharged from a bankruptcy and buy a house not too long after that. And
Yeah,
not
if
too
they've
long
got
after they probably have to
significant down.
qualify. What's that?
If they have significant down, yeah.
Yeah. Right. I mean, it's not like it's impossible, right? But what is it? It has to be at least minimum 12 months outside of that bank, or is it 24?
So FHA requires 24 months after
24.
a bankruptcy. However, I've been able to, it's only been once in my career that I've been able to help a family buy a house 12 months after discharge, the bankruptcy, Chapter 7 discharge, because it was medical expenses and it was circumstances beyond their control, and we could prove that. Most of the time, it's so hard to prove that. So that's why I say, you can think in
24
27
months is
years.
yeah.
Yeah, we've helped a lot of families. We've been able to help one do that in 12 months. So,
But you have plenty of time. I mean, if you're not able to buy a house for 24 months, which still, I mean, 24 months is no time anymore, right? You start to realize how quick time goes by. And if your goal is to reestablish yourself, building up good to great credit after a bankruptcy over 24 months absolutely can be done.
definitely. So, and again, it's still the same principles. I mean, you get that credit card, and I would say, and actually, one of the things that his name's Lars Olson, one of the attorneys that we work with, he says is consistently that once you declare bankruptcy, creditors, they want you to have new credit with them, because you can't discharge them for another 7 years. So you're actually a really good credit risk at that point, which is a little strange to think of. But still, it's the same philosophy. You try to get 2 to 3 credit cards. It might be a secure credit card, it might not be, but you try to get 2 or 3 credit cards, whatever the high credit limit is. If you charge over that 50% level, then make sure before the closing date of the statement, then you call, you get it paid down below that 50% level. Because you may only have a $300 high credit limit. You may not have a large one. So things can really throw you over that 50% level. So get it paid down to potentially 10%, to where you're not above 10% of your high credit limit. That's going to be able to give you the best scores. So we're at 10 minutes here to the end. So keeping some sort of balance below 10% may be the best versus paying it off completely. So here's a question that we do have, and this would be really for you, Jesse. So somebody's saying, so keeping some sort of a balance below 10% may be the best versus paying it off completely for a credit card. Is that correct?
As it relates to maintaining the best credit score that you can, that's the way to do it, right? Leave some sort of a balance on there. Now, I have people that pay their credit cards off, and it's not a problem. You just don't want to leave them there, right? Like, you want to show that there's a revolving activity on those accounts so that they report, they stay active. When you leave a card at 0, it becomes dormant and your limit could go down. They could close the account, right? So I'm not necessarily opposed to paying a credit card completely off. Just don't do it every month, right? every once in a while, leave a balance on there, pay a small amount of interest. It's fine. Again, we're playing the game here, right? We say, you know, ideally 4 to 7% is the sweet spot of where FICO really, they consider FICO's I haven't checked it recently, but most recently it was what they call their highest achievers. The highest achievers are those 780 plus credit scores, 800 plus credit scores. And in that situation, all of their highest achievers were maintaining credit utilization that was below 7%.
Okay. Perfect. Sandy, to your question, if you own a house currently and need to file bankruptcy, is it better to file 7 or 13? Then should you give up the house in the bankruptcy or try to keep it? What factors do you look at to determine yay or nay in this scenario? And I would say, first off, that's a great question for a bankruptcy attorney. Now, between a 7 and 13 is my knowledge, and I don't know if you have any other expertise in this area, Jesse, but between a 7 and 13, the main factors are going to be if you're going to wipe the debt off or if you have to make payments, which at that point, the big factor is really income.
Yeah.
Because if you're over a certain income, married or single, it doesn't matter. But if you're over a certain income, then whoops, there we go. Then you can't file a Chapter 7. You have to file a 13. Now, the question is do you give up the house or try to keep it? You can reaffirm that mortgage if the mortgage company will allow that, which I think most of the time they would. I don't know. I've never heard of an opportunity. I'm sure there are when the mortgage company does not reaffirm it. Mortgage companies don't want houses. They want the payments. So that would be strictly up to the client, whether it goes back, you know, deed in lieu of foreclosure, back to the mortgage company, or if you want to keep it. So yeah, so that would there's a lot of different factors that can really weigh whether you keep the house or not. So I hope that helps, and yeah. So, and if you have some questions, then let me know. Tracy, did you have any other insight on that? You're on mute.
Nope, I just thought I'd pop on for the question and answer period.
And then
These are good questions.
I have so
Yeah,
many
and then,
credit cards that I have a question. I have so many credit cards and some of them have fees to utilize them. So I'm wanting to close them, but that's going to hurt my credit in the long run.
Yeah, that's one of the questions on here. Should you close paid off credit cards ever? Listen, I'm a straight answer guy, I promise you, but some of these are really like, there's not a straight answer for it. It depends on the situation. So I would say that if you have a credit card that is serving you well, in the way of it's helping you establish and maintain good credit, you're going to want to consider at least 2 to 3 of those to keep open, right? Let's say you have 10 credit cards and you're like, I don't want 10, I want 2 or 3, like Jesse says. Cool. Start netting those down. That's fine. But I would do it at a point where you're secure and comfortable with what it is that you, as it relates to the house you own, the cars that you drive, right? And that you're not going to need super good credit in the future. You're going to take a little dip when you start closing credit cards. Well, that's because this question comes up where they're like, well, Jesse, I'm just not using some of these credit cards and they're charging me $69 a year to have them. I want to save the money, right? Or I have 3 credit cards that I use primarily because I have really good limits on those and the interest rate's so much better than the others. Okay, good. So it's totally fine to close credit cards, but it needs to be done strategically based on, again, number one, I'm not planning on buying, making a large purchase in the future. So like when I shake up the credit scoring algorithm, it's not going to hurt me. And then you really need to look at the details of what you're closing. One of the biggest impacts that happens when you start closing credit cards is if they've been open for a long time, there's 2 things that go away. Your payment history related to those and the number of months that it's reported. And then the next would be your average age on those accounts, right? So if that's the only account that you've had that's over 10 years old and everything else is less than 5, it's going to make a pretty significant impact on your credit. So take those things into consideration. It really needs to be a decision of one by one. I would start off with the credit cards that have high interest that really maybe you don't love that, like the service isn't that good, right? Like they charge you to pay online. There really are ones that are like that. And I'd get rid of those first and then just start chipping away. I just had this question the other day. A guy said he had 6, and I said, what I would do is I would close 2, hang out, see how that affects your credit. Wait a little bit. If you're seeing that it just dropped your score 5 or 6 points, cool. Take the next 2. But start off with the ones that are the newest. Keep the ones that are the oldest on there as best as you can.
Yeah. And then also watch cards that, this happened to me where I had a Capital One card that had like a $1,500 high credit limit. That was it. And I never used that card. I actually forgot about it. Every 4 years, I would get a new card sent to me, and I'm like, oh, that's right, I have that one. And after a certain amount of time, Capital One closed my account because I never used it. And then my score went down. It was like 30 points. I was
Oh,
like,
yeah.
you know, and it took a few months for it to start to come back up. So we had another question here on to help a young person establish credit. And so would it be good, which actually the question was would it be good to do a secured credit card or not? What's the youngest that you can get credit? Is it 18?
It
Where you
depends on
get
the
a credit
company.
card? Oh,
It depends on the company, and it depends on what you're trying to set up. My son just left for Washington, D.C. with a credit card. He's 12 years old. And it's because we established a checking account that was attached to our names. He's going to be building credit off of that. So I actually want to break this down and like just it'd be super quick, but like what to do to help our youth establish good credit. I love the idea of secured credit cards. I would make them responsible for coming up with that $200 deposit, right? Like it's all like progression towards opportunity for me in the way of establishing credit is really helpful for our youth, right? And so, or maybe it's you come up with 100, they come up with 100, right? Like, and then you put that down as a deposit. I love secured credit cards. The other thing that you can do, right? And I'm going to jump ahead. All of this that I'm talking about in building credit for youth is to, one, I think it's good for them just in general, but two, we have to get away from parents co-signing for automobiles. Okay. Like you will not believe how many times I look at a credit report and little Johnny's been a great kid, very responsible for the longest time, but the last couple months got sideways and he missed his car payment. And now we're dealing with a husband and wife that are super financially secure that can't pull cash against the equity that they have in the house, or they can't, buy their second home that's a dream home just because something went sideways. There's so much liability in co-signing for a car when we can establish the same type of support and never need to co-sign for an auto loan if we just maintain good credit leading up to when they're in that situation. And that goes by secured credit cards, and then also putting your kids on as an authorized user on one of your accounts. They don't ever need to get the card, right? Ship it to the office. You got their name on it, that's fine. Throw it in your desk, they can never see it. Doesn't matter. You have to maintain good credit on that credit card for them, right? But as long as they're an authorized user on their account, they don't even need to use it, and they're fine. The other thing that can happen is you can put them on as an authorized user, and then you as the primary account holder can determine how much they can spend on that card. You could set a limit. So you might have a $20,000 credit line with Chase Bank. I don't know if Chase does this specifically. You're gonna have to look at, each creditor, their features and functions are different. But I know credit card companies where you can set a specific limit for that particular person, right? We don't want Johnny to have access to all $20,000, right? Let's just give him access to 500 or whatever the case may be, right? So it allows for you to create good practice also, right, of maintaining good credit. And the longer that those are open, the better it's going to help them. I know plenty of people that had their kids on as authorized users. They might have co-signed for a personal loan for $1,000, and they've got enough credit established that by the time they're ready to buy their first car, they can do it on their own, right? And those simple practices are so much more effective in helping kids understand how to use credit, right? And build credit to where you're mitigating your risk completely out of what could be a $20,000, loan that gets co-signed on.
love that. Well, hey, thank you so much, Jesse. There's a few other questions that have come across from anonymous people and that, and If you could do me a huge favor, just email either Tracy or myself. We'll get it to Jesse, so that way you can get an answer if that's okay. And so we're out of time to answer those questions at this point, unfortunately. So again, thank you so much, Jesse. Your insights have been massive today. It will help our clients and help our partners establish better credit, which in turn will help them pay less in interest and save more money so they can spend more in the economy and create more inflation in our economy. So thank you. Appreciate it. All
We'll be
right,
here.
Tracy, back to you.
Okay, well, thanks a lot. Well, appreciate it. I think this was really insightful. And I forgot when you said you had been in the business 27 years. Today's my 10-year anniversary at Fidelity. So
Congratulations.
Congrats.
yeah. So 20 years in the industry for me. So anyhow, I've got CEs ready to go, and thanks a lot for joining us, everybody. And we'll
Thanks,
do it
guys.
Tracy.
next
Have a great day.
time. Okay, bye.